The damages discount rate, known as the personal injury discount rate, is a rate used to calculate compensation for personal injury claims. Or basically, it is used to calculate how much money an insurance company should pay to someone who has suffered major life-changing injuries. It is set by the Lord Chancellor. You are listening to a Sitting with Sue Insurance Questions Answered podcast, and I'm delighted to have sitting with me Thom Lumley, an insurance lawyer specialising in UK casualty claims and a partner at RPC. So Thom, very briefly, who are you and why is the discount relevant to you?
Well, thank you for having me on, Sue. Always lovely to see you. By way of intro, I am a partner at RPC, an international law firm with cross-sector expertise, including, as you say, in insurance, which is where I contribute. I work within our general liability insurance team and specialise in UK casualty bodily injury claims, and that's both on the coverage and defence side. The personal injury discount rate, or the discount rate, is very important to all personal injury practitioners. It's the rate used to help us calculate how much defendant compensators have to pay in damages to claimants where there have been serious life-changing personal injury incidents and where the damages are paid in the form of a lump sum. We use a lot of actuarial information, including actuarial tables. Your listeners will probably be aware of the Ogden tables, and these assist us in determining a multiplier. And then within these tables, we will apply the appropriate discount rate. So take, for example, a claimant who, through their injuries, can no longer work or is severely restricted with their future work and, in turn, their future earnings. A compensator does not just want to hand over a basic lump sum of cash. As such, could be overcompensating an individual who may be able to invest it and gain substantially from receiving all of their earnings up front. An individual would not, in the ordinary course of events, have seen that money for years to come, as they naturally need to earn it. So the discount rate seeks to guard against this and takes into consideration investment behaviours of a claimant, thereby seeking to balance the risk of over or under compensation.
So really and truly, it's almost going back to the principle of indemnity, of putting somebody in an indemnifiable position. So the first question then is, the discount rate was issued before Christmas, which it wasn't really expected to be initially. So why was it issued early rather than in the new year?
Perhaps a little bit earlier than some people were expecting, but given the previous announcements in 2017 and 2019, I think perhaps a lot of people felt it was early, but upon reflection, with the Christmas period and year end and looking at the 2017, it perhaps wasn't that early. It was something that we'd all been eagerly, and with all of the press, the legal press on this, something we were all eagerly expecting the announcement. So not that much earlier than we thought.
All right, so it caught me on the hop, but it didn't catch others on the hop then. So can you just remind me, what is the percentage terms now, and why do you think that percentage was chosen?
Well, the new rate, so from the 11th of January, is 0.5%. This is a return to a positive rate, with the past two rates being minus 0.25% and minus 0.75% respectively. And how has it changed? It's changed through legislation. So we have the Damages Act, 1996, which ascribes it being the duty of the Lord Chancellor to set the rate. And we also have the Civil Liability Act 2018, which ensures that a review of the rate must be conducted every 5 years. Now, this is quite the piece of work, and it involved multiple calls for evidence and a review of panels of experts, which was chaired by the government actuary.
So, I mean, this isn't an annual event, but what are the implications of this particular change over and above what you've already discussed?
Well, the return to a positive rate is a welcome change for compensators, as it naturally entails a reduced sum being paid out. The lump sum now paid will be lower, but with the total amount the claimant should receive over time through reason of the expected investment returns should be the same. So from a compensator perspective, And it's impossible not to mention inflation, I think, in any conversation. The new rate helps mitigate the impact of claims inflation, which has been driven by rising costs of living, wage inflation, medical expenses, and so forth. So this new rate can free up funds for insurers to invest in other areas of their business, which is a positive. It could make for some competitive or dynamic renewal conversations, with insurers now having perhaps increased confidence to adjust premiums in response to this. But again, naturally, that will depend upon the individual company and the carrier appetites and so forth. And perhaps practically, it may be that we see more PPOs, so periodical payment orders, from claimant injury lawyers and defendants alike. But time will tell there.
So we've got quite a number of different implications that we've got to actually sort of keep an eye on. And obviously, a lot of it is going to be driven by world events that then impact on the local UK economy, which then filter back down through to the insurance industry. Am I right on that?
Yeah, certainly, yes.
So I suppose we're recording this on the day that Trump is in his inauguration ceremony. So it could be quite an interesting few months, but we obviously won't see a change really quickly because it does take time. So, Thom, that's been really, really helpful, and a huge thank you for joining me and explaining everything. We hope that we've managed to answer your questions as well. And if you want to listen to other podcasts, then please go to my website at www.suetaylor.co.uk. Thank you, Thom.
Thanks, Joe.